things for as this position that dealt with fintech and financing for bringing in trade finance and export finance as the name of the finish up. So, say just from your perspective, how is work on technologies helping these organizations and businesses in
Yeah, sure. I think we've talked about trade and investment a lot in the previous panel and so far in this panel as well. I think I cannot imagine that we talk about sort of increase in trade volume without kind of the banking infrastructure and payment facilities on there. And that's, I think, where it comes in. So I can probably point out some of the challenges that some of our clients have been facing or we're seeing in the continent. To start with, cross-border payments take a lot of time to settle. We've had clients who have 2 weeks of settlement time. But not only that, it's the uncertainty around sort of when the payments are received. And obviously that damages your relation with suppliers, your kind of operations are affected, etc. And then you have the problem of cost, right? And again, it's not only about sort of your FX margin being too high, but also in a lot of countries in Africa, you don't you have a problem of price transparency because there's no kind of overhead price that you can look at it and obviously understand how much you charge for your transaction, and that's an issue that again has been there, but then the problem it creates is that you basically don't know how much you're charging. You can't control your kind of transaction costs. And then finally, there's a compliance piece. A lot of banks still see at least some of the African countries as a high-risk jurisdiction, which again creates friction when you want to do cross-border payments and delays. And to answer your question, how Verto's kind of address those challenges, I think Verto was effectively born to kind of address all of these challenges in a way. Basically, we kind of invested quite heavily in a platform that effectively reduces targeting. There's kind of almost same-day settlement for a lot of our corridors. There's price transparency. I think we kind of try to make it quite transparent to clients how much you're going to charge. I think some of our larger clients have very defined take rates and stuff like that. But I think compliance also another aspect of that has been some of our clients found helpful. And again, that's facilitated by platform through enabling the best rails for payments through that are effectively consistent with the risk of that payment and the kind of entities involved.
Thanks, Lee. You mentioned a crucial point there about banks viewing African jurisdictions as high risk in compliance testing causes in funds. With that, I'll come to Cobus and to Gabby just to sort of give two perspectives on what should be the same question. We talk about this point, yet data from Chambers of Commerce show that actually trade finance in Africa is quite reliable, and in fact the rate of default is quite low as compared to some other developed countries. But that is of course relatively speaking. From your experience, given sort of challenges of compliance, FX volatility, unstable regulatory frameworks, from a sort of trade and export finance perspective, how can financiers better prepare themselves against future risks and capitalize on emerging opportunities? And then what specific finance mechanisms are the most effective in supporting both regional value chains? So maybe start with Gabby and then obviously can comment discussion.
Okay, I was for 7 years the chairman of the British Bankers Association of Finance and Trade, and so I flagged that because of this following comment. In my opinion, KYC/DD, due diligence done by banks, is a mechanism to actually narrow down the client base of banks. They are shedding clients like there is that. Yes, there is a regulatory requirement to do the KYC/DD, but then it only takes you 6 hours at most to open up a revenue account. It takes you 6 months or 9 months to open up a bank account with a particular bank. So I think one has to be very careful as to what the motives are of banks in terms of the onboarding exercises. And what that means is banks are very fragmented. So banks will now say, I'm only interested in doing this sector in these geographies, irrespective of the risk. So the risk can be completely mitigated. You heard Steve Gray talk about UK finance as a way of mitigating risk. They provide the guarantees 100% for the political and the commercial. So a bank will still say, irrespective of the 100%, I'm not interested because it doesn't fit this KYC due diligence, which in essence is about, is it relevant to them? So that's the first issue. The second issue I would say is that, going back to the previous panel, when you talked about, and I quite like Vivek's 3 pointers, which kind of summed up my career really. He said that projects have to be dollar in, dollar out, replication and scale up, and local participation. And actually, 100%. When you have those three, and those are the things that we identify when we're looking at supporting plans, those projects will get done. We do a lot of the pre-feasibility, bankability studies and working with the clients to get the projects ready. When we go to the banks and we tender the land to the banks, irrespective of how difficult the market, how big the transaction, they're typically 5 or 6 times oversubscribed. So there is, in our opinion, there is no shortage of liquidity for projects which are bankable. In fact, the banks only make money if they lend. Okay? So, this idea that they're not interested in lending, that's huge. The export credit agencies, going back to some of the points I made earlier, they're actively competing against each other. I looked up yesterday UKEF's website in terms of their appetite for the African countries. They've got 52 billion sterling of appetite. They have only 52 billion of sterling appetite. There's 25 countries they will say, come to us, which means if you've got a good project, we will do support for this. A good project in a difficult market. And they're only off cover for 6 African countries. That's UKEF. There are 40 different export credit agencies. And to put everything into perspective, the ECA market is approximately $300 billion per annum, of which half of that equals the state's Chinese, and the other half is split between the major OECD countries. And they are today pumping up in terms of providing support. You heard it from Steve Gray saying it's a two-way kind of relationship. We want to support our industry, our domestic industry, in terms of GDP growth, and also we want to partner with Africa. In reality, it's all about supporting their exports, supporting their domestic. So the governments in the OECD will give whatever is required for these type of projects. The liquidity is there, the political and commercial guarantees are there. A lot of the export credit agencies will literally say to us, what do we need to do to make this project happen? But notwithstanding that, it's still difficult to get projects done in Africa. So I think you have to look at those projects which are hard currency revenue generating projects, oil and gas, minerals. They're relatively easy to do. The dollar in, dollar out. The challenge, I think, is the social infrastructure, the hospitals, the water, the housing, the education, kind of agri, where you don't have hard currency revenue. But at the moment, a lot of the debt is in hard currency. currency. So you're creating this FX risk that really shouldn't be there in the first instance. And one of the things I find really disappointing is that in the decades I've been in this, the growth of local currency financing for local currency revenue generating projects is unbelievably low. With the exception of South Africa, where you want to talk about that maybe later. But South Africa is slightly different in that there is, and I've been very privileged to do a lot of business in South Africa where it was all done in rand. Part of that is regulatory, but part of that is the sophistication of the South African banks and the fixed income market in South Africa. But the rest of Africa, it doesn't happen. Notwithstanding the fact, if you look at, I just looked up a few moments ago, Tanzania, they'll issue, Tanzania issues, the government issues 20-year bonds. So if anybody says to you, well, there isn't the depth of appetite in Tanzanian shillings for 10, I disagree. It's there. The challenge, I think, is that the banks with the knowledge and the sophistication to package these transactions together are here. The funding in local currency is there. And the majority of the banks that do project finance, whether it's PFI, PPP, VCA financing, most of them are in commercial banking models, where their KPI as bankers is about annuity income. How big do I build my book? You speak to them, you just stop them, my money is 5 points. They just want to book assets. They want to book hard currency assets. So they don't want to book in local currency assets because it's worthless. And I think that gap between the two is one of the biggest restricting developments of local currency financing. My last point before I pass on was going back to aid. I've never agreed more on that. That there should not be aid except for two examples. One is in terms of disaster relief, and the other is in concession finance. And I think if you look at the Chinese as to why they're so successful, the Chinese provide concession finance, i.e. long-dated, cheap finance. And that is for a lot of developing countries in Africa, that's what they need. Okay? They need 20-year financing. They need it at 1% fixed. What they don't need, the Americans often, the US actually also say, we think it's an unfair advantage and we think it's wrong China to do it. Well, what's your alternative? Shorter, more expensive debt. How does that fit into the affordability question for Africa? I think just ignore them. Chinese are doing it right. But if you want to read the full story, it's a really good book by Dambisa Moyo, Then Aid. I read the book about 10 or 15 years ago, and it's great. She's African, she's an economist by background, she's at Goldman Sachs. And you want to read that book, it's not a big book, but it will put you on aid forever. Pass you the thanks.
Thank you, Gary.
Yeah, maybe I think it's good I agree. I just maybe want to reply on a couple of comments that were made. I think the notion that there's not funds available, whether it's development finance, private equity, bank finance, there's no limit of money available for Africa. I would say, we also have an advisory business. The issue is there's a dichotomy in the market with regards to size. Comments previously made, well-prepared transaction with everything in place, you can do business all day long. But I'll maybe start with this interesting question. I'm going to give you 3 options and you need to vote. Where does the upper ring of SME, let's go for ticket size. So this is for development finance institutions. What is the LPs prescribing to the private equity funds for the definition of African SME? What is the upper end? I'll give you 2 options. $20 million, $50 million, or $100 million. Everybody for $20 million, put up your hands. Upper end for $50 million, upper end of $100 million. Okay, the most. The upper end is $100 million for an SME in Africa. Okay? Now, so our advisory business say we are mid-market advisors. That's transactions 10 to 100 million. Ticket sizes 10 to 100 million US dollars. How many businesses in Africa, how many SMEs that we would say at a local level has got the ability to justify getting a $10 million US dollar debt instrument into their business with a short-term 5-year term loan repayment structure? It is extremely difficult. If you go and look at your local banks, let's just take an example in Southern Africa. There's now, let's Nigerians put a bit of pride in the pocket. It's a well-developed market. FNB, South Africa, very entrepreneurial bank. Their limit for SMEs in Namibia and Botswana and Zambia, where they operate, is $3 million. After $3 million, the guy has to go back to a credit committee in South Africa. So this is very important. So I'm going to make a couple of comments. I've been asked to comment on what is the trade finance instruments available in the market. I'm not going to go into the export credit finance, which is a very important aspect of it, but I will just comment. It is all these instruments that I'm going to mention now, that it is horses for courses. It is the right instrument for the right type of trade, for the right size business, and that's where we get it wrong quite a bit. So our trade finance business was focused on the most desirable instrument of all, called the letter of credit. Now, we've all heard of it. We get emails every week of support for letters of credit in West Africa. But what is the reason for these instruments? Is actually, one side of it, as we all know, is liquidity. But the other side of it is actually its security of it's providing a secure rail and instrument to give comfort to everybody involved in the trade cycle. But if we have to speak candidly with each other, is the letter of credit is almost unavailable for ticket sizes under 10 million US dollar today. So how many SMEs for single trades or repeatable trades have got the ability to block off funds in their accounts of more than $10 million for letters of credit to be issued? The cost of a letter of credit is extremely high now, to the point where I would say debilitating for a business with turnover under 200 million US dollar a year. It is, and then even the South African banks today is not investment grade. So you can have a letter of credit issued by Rand Merchant Bank, FNB, Standard Bank, Absa, very highly regarded, and yes, they've got very good corresponding bank relationships with banks, but try and present that Rand Merchant Bank LC to a US exporter. They will ask further, you will need to get a standby letter of credit, you will need to get confirmation on that letter of credit, adding more cost to it. So it is unfortunately a very difficult scenario that we have. I'm not going to go into the details of letters of credit, but to Gary's point earlier, our business is focused 100% on Sub-Saharan Africa. We were at Barclays, client for 10 years at Barclays, and then in 2019 possibly running very smart with Barks and so on, when we started presenting those Zenith letters of credit to Barclays. It was just one day we received a letter and say within 3 months all our bank accounts will be closed, we finished with us. We had a turnover of more than $100 million in AMC Trade Finance, because it was a decision that was taken based on your balance sheet and so on, and we just didn't make the criteria, and I think very few African businesses would have made the criteria that Barclays, obviously in that state, drawing out of Africa. So these are real issues. The second instrument that I would maybe just want to talk about is obviously supply chain finance, which is more the SME, it's more the suitable SME product, and it's provided by tier 1 and 2 banks in Africa, quite across West, East and Southern Africa. It's also quite a good form of finance for the alternative financiers out there. So just remember, if you're an alternative financier like we were, and there are all the funds that are operating, the alternative trade finance funds operating in the market, they can't issue LC. So that mechanism is almost not available for anyone because you need to go and get to a supporting or bank to issue LCs, and it's actually not possible. And so the typical instruments there is your invoice discounting and reverse factoring. And there I could just say, in most African countries, reverse factoring does not really exist in outside of the top 5 sub-Saharan African countries. But that is what's required. Then,
Can I add something?
yeah, you're welcome.
My take is that the knowledge and capability of banks to do the short-term trade, and understanding of reverse factoring, the ability to do a bill has been lost.
I agree.
And actually, I see a shift in alternative funds provider. And I'm going to go this if you want to add on to that. Banks are pulling out their capabilities of being able to do things that they were able to do 20 years ago.
Yeah.
You try discounting a bill of exchange here in the UK, in the London market. There's about 3 banks that can do it, 3 or 4 banks.
Yeah, I would like to comment on that. I'm actually going to go to that second that
Sorry,
yeah.
could we do 1 minute with you?
Yes.
I
will.
to respond to that. I've got a couple of questions just for Saeed and Thomas.
I'll maybe start with this point that Gabby raised. If you've got a child that's interested in finance, go and look for him to study international trade at the international university because it's a lost business. I had 4 people employed in my business over 65 years old because it's a dying trade. Very prevalent and required in Africa is warehouse receipt financing. It's extremely difficult. The insurance is not available. All the collateral managers everybody's got a court case against them. Everybody has got an issue with insurance. So commodity insurance is a major problem. And that is why it's very difficult for alternative financiers. That is the reason why I sold AMC Trade Finance. I saw that it became impossible. But that is what is driving cocoa, coffee, cashew, iron ore, copper, everything that's lying in a heap in a warehouse at a port in Africa, all across Africa. The trader, the farmer, the cooperative, whoever is trying to use that collateral as trade, requires this type of financing, and it's just running up. There's just no more support for it. Even in South Africa. So even in Nigeria, they pulled out of Nigerian banks, pulled out of all types of warehouse financing because of fraud in the collateral management side of it. And so it is something that will need to come back into the market to loosen the chains. And in my personal view is, with the shipping costs and everything, with the brokenness that have come in the last 3 years, but the fact that there's no finance to grease the wheels is one of the major drivers of inflation, in food inflation globally. And nobody speaks of it because it's a complicated thing to explain in the Daily Mail or the Financial Times, even to the sophisticated people, because trade finance is not it's a dark art to most people in the finance. Anyway, that's my little bit in 1 minute.
Let's do rapid fire. I want to get question to Saeed. 3 points only. Just in terms of sort of trade finance, continuing the theme, 3 key cost and risk factors that business encounters with capital trade and cross-border payments in Africa. Just 3.
Yeah, I think liquidity has been a challenge, definitely. A lot of countries deal with shortage of liquidity. Again, access to banking infrastructure, and businesses, like UK businesses who can basically transact in Africa. Again, this is recently trying to help them effectively collect the security funds here. And then I think there are sort of smaller sort of transactions as well, like and I think linked to the first point, your business, you will pay for your software subscriptions, for example. there's been again a lot of challenges in terms of payments and support the fintech and where it's been kind of implementing and trying to do this.
Thank you, Saeed. Just again, rapid fire for you, Thomas. Just the role of the chambers of commerce in facilitating trade finance.
Yeah, I think it's a very key question. And, I would say the role of International Chamber of Commerce is, I would say, on one hand, doing the advocacy, lobbying with the international institutions. On one side, on the European side, making them aware about the challenges, but also I would say partner more with the African Development Bank and other institutions, within Africa. And also, creating awareness on both sides. And this is where, these business forums, as I mentioned before, come in as a key player. It's high time that we change the narrative of a lot of African countries like Nigeria. I can say, unfortunately, Nigeria, it doesn't really have a really positive image in Belgium. And that's just a fact. That's not my feeling because, well, there are many reasons why. Because it's a very unknown market to Belgian companies going there. The main focus is oil and gas. And again, I'm saying that these are facts for the Belgian side because
Let's have a trade mission to Belgium and take the Nigerians in so we can explain exactly why it's the biggest market on the continent. It has a diverse.
Yeah, well, I'm coming to that. So I'm the one in charge. I'm not diminishing that because I'm the one in charge of Nigeria. I go to Nigeria almost every 2 months. So I'm 100% convinced of the market of Nigeria. That's why we also started organizing this annual business forum on Nigeria. It's the 3rd edition happening in October, so you're very much welcome to be there. But what I'm saying is not a personal sentiment, it's just a fact how Belgian companies perceive some of the markets, taking Nigeria as an example. So we, of course, as our chamber, we believe highly in these markets, and that's what we're also doing. We are doing the advocacy, we are promoting the opportunities in Nigeria, and we are happy that we have the big players on board from Nigeria. We have the Lagos Free Zone, which I think we all know.
Thanks, Thomas. I'm going to stop you there. Just
Thank you.
The African continental free trade area has been mentioned a number of times across the past few sessions. Veronica, just to finish off, 31 and 48 have ratified starting to implement trade. What do you think are crucial policy reforms that we need to advise the new and really sort of echoes Roger is very working on African clients and investments into the market. That's a phenomenal macro view. Maybe sort of going to something slightly more granular, and I'll let the others comment, but Thomas in particular. Taking sort of Belgium, Luxembourg, and your role in Nigeria, putting that into sort of context. Does your experience sort of resonate with what Veronica has said? We can see there's a remarkable evolution of trade between Belgium and Nigeria. You started with pharmaceuticals and heavy resources in the 2000s, and now I think Belgium is the EU's largest exporter to Nigeria. I don't know how the story plays out in your experience.
Yeah, no, but very good question. It's actually a bit, I don't know if I can say funny, but actually Belgium is the biggest exporter to Nigeria currently of refined petrol. And of course, as a country, as Nigeria, being such a big producer of oil, let's be honest, it doesn't make sense. But of course, in the recent years, we have now seen the Dangote refinery. We've also seen the Nigeria, the National Petrol Company.
NNPC?
Yeah, NNPC, exactly. You all know the big player there. Now they are promoting, also LNG, and they are setting up these stations across the country. So I think what we have seen in recent years is the development of local capacity of refineries. I think the Dangote refinery is the biggest example. And personally, I'm quite satisfied that finally this capacity has been built up. It should have been there, from the start, to be frank, because come on, it doesn't make sense to send unrefined petrol all the way to Belgium, refine it and send it back. Even we in Europe.
So this is according to Disrupt Africa. If you have actively followed investments in tech, VC funding, you will know that it's like being more declines in the VC funding. In between high interest rates, currency fluctuation, and VC retreats. Looks like African startups, tech companies have generally sort of suffered the shorter end of the stick. And I'm going to start this question. I'm going to start with you, Peter. What have you seen in the last 12 to 24 months? What has changed, or what is changing?
Well, it's been a very difficult investing environment, right? Capital is the blood running to innovation, right? So when you starve out the capital, a number of things happen. We've seen, of course, the fall in the amount of capital has come onto the continent, and this has been experienced by even both the funds, right? So even those funds getting money from LPs has been very difficult. So what has happened as a result is capital has become more clinical, right? Capital has become more cautious. We're looking at backing companies at just don't pitch ambition. You pitch anti-fragility to a point, right? We look at companies that are building from Africa, right? We want to see sustainability. Once upon a time, it was grow at all costs. Now we want to see, not immediately, but we want to see some sort of road to revenue, right? We want to see that it's a defensible company. Something that would survive in difficult times, right? Because there's something that's become apparent in Africa, and this is not to immediate cycles, but we have good times and bad times. And what we're seeing in bad times, it's been a bloodbath for a number of African companies. They've not been able to survive. So one of the most important things for us is we're looking at things from a sustainable point of view. If this company does not continuously raise money, can they defend their position? We're looking at things like operational efficiency, unit costs, economics, in terms of how companies spend, right? And before it was, like I said, expanded our costs. We're looking at not necessarily tightening things to destroy innovation, but is that sustainable part of things? Another way of looking at it is, and I don't think this will last forever, it's just for a climate where there's very little capital. So we're sort of like moving away from disruption to durability, right? Where, like I said, I'm looking at something that I think would be resilient. It's no longer just about velocity anymore. Right? So we're looking at sustainability is a key thing. Now, this doesn't necessarily apply in other climates, like when we're looking at companies in the US or when we're in Europe. When we're looking at companies in Africa, we've now gone a full cycle in this new tech thing. We've had the good, and we see how fast companies can grow. We see what the opportunities are like. But we also see when things are bad, right? When the currency devaluation comes and your revenue is slashed by 50%, when you can no longer raise capital from foreign companies, but the business case is still there. So being sustainable is really important. Being able to defend the position is really important for us. So we're seeing a lot of change in behavior from founders. Like I said, we tell them just don't pitch ambition. Pitch anti-frugality, as to I understand the market, right? When we're looking at founders, we're looking for founders that, apart from understanding the domain in which they want to build, but they have a deep feel and understanding of Africa, because it's fundamentally different from the rest of the world. It doesn't have the infrastructure and a number of other things. So we're seeing a change in behavior from both investors and the really good founders are adjusting to this new climate. No more vanity metrics. We want real, right? Real metrics.
And sorry, just to round up that point, has that caused the increase in the number of investments you've done, say in the last 1 year, or that has actually caused you to say no to the new companies?
Well, it's different for different people, so it depends on the site. Funny enough, for us, last year was we made the most investments we had since 2021, and that was because we had just closed the fund. But generally, last year was a very difficult year for the country, for the continent generally. And again, it's because you're looking at a number of these companies again, looking at the climate again, and are they worth those valuations? Will they grow at the speed that you think they will grow? Will they be able to execute their plan in this new political climate? So that pause in looking at both the continent again, looking at the macro issues again, is what's caused that freeze. It's not that the money is not there, it's just that the money has become a bit more clinical, right, as to how it's executed and where it is.
Okay. I think that's good news to hear that for a fund, even though the majority of the popular business is like companies struggle to raise money, you actually deployed more. And that brings me to repair. In the last 12 to 24 months, especially from the private equity side of things, what have you seen, what has changed?
So what's been really interesting, and I think first of all, observing what VC funds are doing is, I think they're focused on raising more money. So what you see is valuations not coming down, marks not coming down in portfolios. And then as soon as they kind of have first close, in the new funds, suddenly you have a big drop in valuations. And that's a big problem, both from a portfolio management perspective for ourselves, but also in terms of raising more money for those startups, because effectively they're stuck. They can't raise more money until their owner has raised their next fund, which is an issue. I think that's a fund level issue. Then observations at the company level, I think, Peter, you had great observations, and I think I can echo a lot of it. Is how can you be, and I'll use the same word, clinical. So companies trying to find a way to have a runway, getting their hands dirty, cutting costs, being focused on how to create demand. Do you spend more on marketing, or should you maybe just focus on retention? I mean, I have examples where companies spending on marketing, but actually their CAC keeps increasing, whereas actually maybe guys just keep marketing down a little, focus on retention. So that's an example. I think focusing on this is not the great days where you could just raise money to fill a capital gap. Now you need to actually focus on your runway, understand the length of your runway, so that you can survive. And I think that's in terms of cost management. I think what's important as well is creating and working, I think for founders, working on stories that are sustainable, that I think you had the days of delivery apps, effectively copying a lot of the business models that we see in the US. In Europe, you have the delivery app, you have that Uber copycat, etc. You name it, and but that stuff requires a ton of capital just to be there. I think founders that are focusing on ideas that are more sustainable, just if you can generate revenue, maybe quicker, but not just revenue, to generate maybe profits or losses at just maybe single digit percent loss. I think it's all about focus and and I think another matter which I think has not changed, unfortunately, is getting emails all day long from founders, so cold emails or otherwise advisors coming with ideas every single day, and all you get is just a broad idea. there's a startup doing this thing, no numbers, just a broad idea. Are we really in a market where you can simply have a broad idea? Maybe it works in the US now, AI, and people just put money behind an AI story, but I think getting those high-level ideas with limited numbers, limited work done by founders is difficult. There needs to be, I think, a shift in mindset in terms of, am I building something real here that is not just following a theme that indeed requires a lot of capital.
Thanks, Ben. Chris, I think what would be interesting to hear from you, given the work you do with technology, and just marrying that with the fact that equity has been, VC funding, equity has been retreated. There's been some sort of increase in venture debt. Is that what you're seeing? What have you been experiencing in the last 4 months?
Yeah, and look, it's a very interesting one, and guilty as charged. I'm one of those advisors who does exactly that. So let's take a step back, and then we'll move into funding. The first thing that's happened across African technology is sophistication has changed absolutely exponentially. I think it was a very, very hot, it was hot sector money probably 3 years ago, $5.2 billion raised in venture capital. Leading up to that point, it was you saw it quite often. When people raising money at extortionate values, basically doing copy and paste, paint by numbers fintech versus developed markets fintech. And Africa is unique. Africa has unique issues, and good fintech applies to African issues in an African context. Those companies that can answer it in that way, not just racking up costs, having expensive marketing, putting all the gloss you can do on everything, expensive offices, living in Dubai, living in San Fran or otherwise. Peter, I'm sure this is half your portfolio. It kind of, people figured it out quite quickly, and actually we've just seen this whole flow through, and even just the nature of how tech's presented. I've seen so many pictures now that start off with billion people, cash hungry, consumer hungry, 90% still cash, 10%. We could grow the whole world by 90%, tenfold. It's like, no, fintech's about, I do agree, so that we're a bank. We focus on the top 20% and we don't really bank the other 80. That's not our game. Fintech is designed for the other 80, Africa's growth engine. And that's important to hit, but people aren't getting the message across, and also understanding the nature of total addressable market, what's actually relevant total addressable market, because the number is slightly different. And the more that people understand it, the more people are seeing it right now. Going back to the point about what this means in terms of equity, it's not necessarily the equity's drying up. People have just got smarter. And actually just going in with a very nice spreadsheet and presentation doesn't get you $5 million of venture capital anymore. That just doesn't happen. But what we are seeing is the sector is developing significantly as well, because we're seeing debt coming in. So Standard Bank, we do less on the venture side. We're more from series kind of A to C, taking you through to hopefully to an IPO, if it stays within my portfolio then. But actually, the other point is that people tend to try and focus on 100% exit as well. We'll move on to that in a second. But we deployed nearly $500 million of debt to, probably A to C series companies, the likes of Copper, the likes of what they're called Zeps now, but you probably know them as Margaret Mitt, Juno, and big sums of capital for companies that aren't profitable, just turning EBITDA positive. We've got over the hump, and look, we're a 160-year-old bank in Africa. We're not the smart new guys that we've had in some of our other panels. We're here, we're established, but we're not going anywhere, and we back the sector. The last factor with it all, and it's kind of beyond your stage, because this is kind of where the VC money then flips it into, I guess, probably more the Series A, Series B, Series C, is the biggest answer, or the biggest question you have to have an answer for, is around exits. And because there is now hundreds of brilliant junior fintechs across Africa, thousands probably. Great companies, but they're all just small operators. They're not, they're a $5 million company, they're a $1 million company, but doing amazing things. Unfortunately, for Pierre, it takes him as much work to buy a company for $5 million as it does to buy one for 500. So you have to kind of think about relative returns, and we've got to think a bit more about aggregation of businesses. We've got to also remember that, well, let's think about it. There's 12, we make about 15 unicorns at the moment. Let's say at the lowest end of the value, that's $25 billion of capital that would need to take them all private, or take that to buy them out. We've only seen Paystack do Stripe at $200 million. That's the biggest we've seen in the sector. So to get from 200 million to 25 billion, I mean, that takes a bit of a leap of faith when you've got a falling capital base. So we've got to be thinking about different sources of capital. Actually, the public markets, it is a viable thing. And there's a public market for everyone. There's a local market. So start on the NGX, start on the NSC, start on the Uganda Stock Exchange. Focus on different things, focus on the customer base. I ran the MTN Uganda IPO in 2021. We did a customer offering. We tripled the number of securities accounts on the Uganda Stock Exchange overnight. People could invest using a feature phone, just *157, hashtag, whatever, and could invest using their feature phone in 30 seconds in the IPO as a customer and get a good discount, and they've all made almost 100% gains. So the capital pools are evolving, they're changing, the geographies of investors is changing, but we've just got to be alive to it and not just focus on the negative views. We've actually got to focus on the suite of what's happening today. It's actually just a sector that's evolving. It's not necessarily down in the dumps. I think it's actually just changing.
Yeah. I do like the point that you mentioned about, with the MTN Uganda IPO where you were able to get customers to participate. And I think that brings us to the question around, do we need more local funding? I know this sounds like a broken record now because it was discussed in the first and second panel, but we were going to talk about it on this panel. Again, given the fact that you're looking at VC equity, patient capital, should that be coming from investors, people on the continent, much more than foreigners? And happy for you and Penn State taking more of this.
Well, the problem is you've got a lot of funds that are US dollar funded, investing in companies that make money in local currency. So, despite the businesses performing fantastically, they may grow 30, 40, 50%. If you have a 75% deval in Nigeria, that wipes out gains in dollar terms very, very quickly. So I think that it's much more important to start seeking local sources of capital. Unfortunately, a lot of the tech infrastructure is only payable in dollars. But it actually goes beyond that. It's actually just being able to get Naira out of the country. That's the bigger issue in Nigeria, and that's the reason why there's an FX deval. But I do think we're seeing that. We do a lot more local debt with companies. I think it's right. And to the same point, we shouldn't be valuing companies that are Naira denominated, shilling denominated in dollars, because actually their performance is in local currency. That's what expresses their growth. So we need to show more constant currency, more. You can be this because you always focus on your fund, but we've got to focus more on constant currency so we can focus on the high points of the sector.
Actually, so local currency funding, maybe I'll share an interesting observation. The equity markets in Africa, you look at, and I'm talking about public equity markets, 2024 was fantastic, right? Markets all on fire. Year to date, 2025 also extremely strong. So we're actually seeing, in local equity markets, there's a lot of local appetite for capital. And so for us, it's been very helpful. We were small investors in the biggest IPO in 15 years in Morocco, so an agriculture-linked business in Morocco. And as an IPO that, after introduction in January, is up, I think, 70% from IPO price. I mean, it's fantastic. These are stories that, I think it's actually only recent that we really see these moves. We also have an asset in Nigeria where there was an IPO. It's very successful as well. I think we are seeing more appetite, good performance, which creates liquidity, which is helpful. So that's, I think, the angle a little bit on local currency. I think that there is more happening, and it's good to see.
There's a bigger issue with local currency debt, because the banks, Nigeria is a case in point. Banks can just invest in T-bills and you get your tax rate. So effectively, this is a massive burden on the ability to fund SMEs with the local banking industry. So actually, I think they need to put more pressure on lazy banks to actually focus on SMEs. I think that will be absolutely key. We can do it, but we're standard bank. We can do it on the standard levels, which is smaller. We can't do the whole thing, and we shouldn't be doing it alone. We need to have the whole industry focused on this, not clogging up their balance sheets with T-bills for the government, which doesn't filter back down, unfortunately.
Of course, local currencies. I don't think we reach the heights we need to reach until we unlock local currency. Is it happening fast enough? No. Will it happen? I don't doubt it. I think we all doubt it will. If you take an eagle eye, you fly up a bit and you look at it over a 10-15 year period, the trajectory has been phenomenal for tech and investing in tech. It's the first downturn, so let's look at it like this. The wealthiest, I'll talk about Nigeria. Some of the wealthiest Nigerians, almost all of them have their companies listed on the Nigerian Stock Exchange. Almost every single last one of them started that company. And yes, it's taken a much longer period of time, roughly about 15 to 18 years for it to become a billion-dollar company. And I'm saying the wealthiest Nigerians that we know, this is one of the fundamental ways in which they have made and retained them through the markets. This tech development that we're seeing, I say this quite a lot. I'm a bit old, so I've seen it before, almost exactly the same. And this was a point in time where the founders were between the ages of 35 and 42. They were the CEOs of Access Bank, GTB Bank, Zenith Bank. They were 35 to 42. And they set up these tiny, ridiculous banks that we didn't think would compete with any of the institutionalized banks that had been around forever. It just took them 17, 18 years to become billion-dollar companies, right? So can it be done? Without that? Is the capital there? We go back again to 2008 when they changed the banking consolidation. What led to these banks becoming these great banks today, right? Where they moved their capital base from 2 billion naira to 25 billion naira. And what we saw during that period of time, I don't think we've seen it since, an unprecedented amount of local capital went into it. Everybody, from the drivers to the cleaners to the professionals, every single last person participated. But what happened was Lehman Brothers collapsed, financial markets collapsed, and nobody could get out of those shares. And the Nigerian market it's been difficult since. The last 2 years have been phenomenal. Now what we think, again, it's a thesis, right? Clearly, what we have on the table is not working, it's not sustainable. We can't continuously be financed by foreign capital. If America is telling Europe that we can't finance you forever, imagine imagine the sort of things they're thinking when it comes to us. We can't be financed forever. So how do we convince local capital? No one's a charity. Nobody is a charity, and you can't, as we've seen with DII and a number of things, you can't blackmail someone to do the right thing, right? We saw that capital that went into female founders. After the last 5 years, the amount of campaigning that has gone on last year was the worst. So what we're saying is that you can't blackmail or make people feel bad to do something. So we've got to think about it deeply. I know that the Nigerian Stock Exchange has launched the tech board. A number of African companies are looking to do it, but I think that's the way to go. Like I said, when I give examples of all the banks that have become billion-dollar companies, it's just taken a longer period in time. So maybe that 10-year fund period might not be the right way to do it. In terms of how we value companies in Africa, might be considerably, it should be different. An example is, we're having a number of conversations with the Nigerian Stock Exchange. I know they're putting together this really big phenomenal event in a few months where we invite everybody to come to have this conversation with venture capital, with private equity, angel investors, with startup investors. Now, what does it take to get you to list? Now, a few years ago, if you speak to any founder and you mention any African market, he will laugh at you. Speak to him now, there's no foreign capital. He thinks very differently about it. Not all companies will become billion-dollar companies, right? In the African context, the company grows to a $50 or $60 million company. That's phenomenal. Absolutely phenomenal. From scratch, you grew to a $50 million company. We talk about $100 million, $200 million almost as if it's the norm, you know, right? And these are part of the reasons why that Africans did not invest in the first wave. I know it's frustrating, but we've got to be real. A number of these gentlemen and ladies built these phenomenal companies. The most amount of money they actually ever raised in their lifetime would probably have been $250,000, $500,000. And they spent time to build these phenomenal companies. So then we show up to them, you know, ripped jeans, t-shirts and stuff. And we're telling them that we want to build a company, pre-seed valuation $15 million, and we want them to invest. He or she has not got the slight. In fact, it's not a mistake, you're lying. It's almost criminal what you're asking. Right? So the foreign capital comes in, proved that these innovators can build something of some sort of value. So the old guard now say, okay, well, this does begin to make a bit of sense. We still think it's a bit too expensive, but it does begin to make a bit of sense. Now, again, they're used to the stock market. It's how they've always invested. So it is working together. I suppose not all companies. Some will be outliers, and some will go to Europe and America and become $1 billion, $5 billion, $6 billion companies. But for the majority, I think a lot of value is lost if we don't start to consider these things. And it will not continue until we start to see exits. It's just, it's not a charity business. It's real business. So I think local capital is improving. Local capital seems to understand it a bit more than they did 4 or 5 years ago. So I think it's just continuously working at it. The best founders will always raise money abroad. There will be a number of people, which is happening now, that are raising considerably locally. We're seeing more and more funds. I think we'll get there, and I think it's now a conversation that we have to have. I wouldn't say we've avoided it. We've gone through the process. We've gone through the motions, and the motions are great companies can be built in Africa. They can be built really fast in Africa. They might not reach the heights of other places, but they can be built. If you ask a number of, I speak to a number of our founders, especially in some of the companies that have closed, the spending that we talk about, right? A lot of the spending. Prior to 2018, 2019, never spent that much. Never. But they raised their money from America and Britain, right? And America and Britain want you to spend $300,000 a month on marketing. There's no human being in Africa that would do that, right? It's just not what we do. But this is foreign capital that's been raised. We want you to acquire those clients, and we want you to acquire those clients really quick. So go out and spend the money. I mean, the founder's looking at the VC saying, really? Well, right? So everybody, a number of them grew up on cheap money. Hence why a number of them, living abroad and stuff, right? It was cheap money, copying their counterparts. Now we've had the doubt. Like I said, now the story is sustainability. And even when capital does come back, I don't think there will be some things that wouldn't happen again. A number of the fund managers have now lost a bit of capital. They've looked at a number of investments which they've made, and it is been embarrassing. For them, that this has not been well thought out. So I think it's a general process. It could be faster, but I think we are getting there. I think local capital will continue to increase. It should be more, but we'll get there, because you can't expect foreign capital to continuously come if local capital doesn't want to, jump into the arena. But we're getting there. It's not. I know it's been difficult. I know it's been a difficult year. I mean, some say it's not been a funding winter. It's more been a startup filter. Getting rid of nonsense. I mean, some say some of the best companies are built in difficult times, not in easy times. So we do say we invest, especially when it's Africa. If I said this 4 or 5 years ago, I'll be looked at like I'm trying to destroy a company. But we invest in Ghana, right? It's Africa. We know that not everywhere has roads or electricity or power. So the way I look at a company, how the company makes revenue is completely different to how I would look at it in America or Britain. And I think those are some of the mistakes which we made over the last 3 years. But it's part of the process. It's part of the process. I think we're getting there. And I think local capital is now more intelligent, more aware. understand a bit more. It's still going to take a bit more, but we're getting there.
I really like the point that you made about, global capital kind of having like the learning curve. You sort of had time to evaluate over the last 10 years, look at what can do. These people can build businesses in a way that's different from the way we are part of the first businesses. And there might be some value here. And now that we have the correction, right, there's now an opportunity for them to come in and maybe come in and do better valuations, change practices, as well as like different expectations for what you expect for an African company. And I think that brings me to the next question around, given what we've seen now, you're saying the capital is not clinical, what's the right claim for this sort of environment? And it might be that this is the right environment for Africa, right? We shouldn't have built companies or encouraged our startups to be able to their counterparts in Silicon Valley or other countries have lived, right? So there's been a correction, right? So what's the right thing in terms of how you engage with the founder, what the founder should be pitching, how they should be looking at the business model, what they should be building, right? After we increase.
Yes, I think there are two areas that I'd advise people to look at, and if you think about what's the right idea in Africa, I think one, solve a global issue, and two, accelerate the domestic African economy. And so, first one, what do I mean by solve a global issue? So, deep tech, AI, and I'll give an example. So we were in a business called Rapid Deploy in South Africa, which out of South Africa is making the technology that runs 911 calls across the entire US. And that business just maybe 2 weeks ago, we exited to Motorola Solutions. So great exit, but that's a South African business. Another example in our portfolio, we have an Egyptian semiconductor business that services also the US in that ecosystem of that semi ecosystem. So how can you use local talent to solve a problem that is not just African? Then my second point is this time, what can we do locally? And this is I think the issues so I have access to, and I'm involved with a lot of businesses across the continent as a private equity investor this time. And now you sit down with your CFOs, with your management teams, and the issues we see are massive. And you just think, some of the services you see in, internationally, software services, for example, that there are so many problems to solve. And I can think about, how do you run a payroll more efficiently vis-a-vis local regulations? Because you can't just use say your UK payroll system, it won't apply. So we've tried to, improve costs. For example, our HR team is underwater. We need so many people just to figure out how to run payroll. But because local regulations are so complicated and a lot of it is done by hand, and there's no software, then effectively that's a lot of cost for us. But if someone actually was out there with, say, a payroll system, a SaaS solution, we would actually pay for it, and it would be, it would grow. It would be a real business out there. We have in many markets issues with financing, getting paid by suppliers, even just running basic matters that you see in a lot of finance, SaaS solutions, in the US or Europe. But again, they're not available. And you can't copy paste, once again, even in the finance space, you can't copy paste CFO solutions. They need to be local because of local regulations and local needs. And I'm like, this is so obvious, but yet nobody's building these things, and people are trying to build, other ideas, whereas the basics are not necessarily solved, and they would really accelerate growth on the continent. So I'd really advise, founders to look at. Figure out what are the pain points management teams and businesses are facing and how to solve them with software. Other basic matters we've been involved with recently. Say waste collection it's a basic need for as cities grow. the logistics are just not there. So one, we've actually incubated a startup within one of our industrial businesses to collect waste, because we actually need the waste in that specific business as a feedstock. So effectively having an app so that households and businesses can provide the waste to us. And we're actually seeing there's some VC money that is going into that space with more the climate tech type strategies. But you're literally just seeing it across a handful of countries. There's a business in Nigeria doing this, but they're collecting a few tons a month. Like it's nothing. If I think about what we should see is thousands and thousands, tens of thousands of tons of waste, not just a few tons. So, but you're just seeing so much potential, and I'm really excited. There's so much potential out there, and I'm really excited to be part of it. I think that this morning there was a conversation around industrialization, creating industrialization on the continent, and there is massive opportunity to do so many things with whether it's actual industrialization by putting up a plant, but then you need all the tech behind it that people don't necessarily think about. If you have a new plant in a new country, but there isn't that industrial fiber in the workforce and in the country and in the supplies, you're going to need all the tech framework around that specific industry setting up, and that's and so for us it's a challenge. We think about setting up an industry in a specific country, but then we think, actually there isn't all the usual services you expect. They're not there yet, but certainly they should be. So the question for us is actually, do we fund it ourselves? Are there startups that can come in? It's not necessarily our role. If you invest in a specific industrial business, you don't necessarily want to do all the tech plays around it. But there's just so much potential. But people maybe need to think simpler around what is needed, and then try to have strategic partnerships with people. So not necessarily just going to VC and saying, "Look, I need some money for my business idea," but maybe finding a business that has a real need, partnering with them, building the tech solution, getting them as a customer, as a cornerstone customer, and then growing from there. Very excited about the future. There's a lot to do, but I think we're just at the start of the curve.
Thanks, Tobias. I think from what you said, I'm taking it solving a global problem, finding a pain, and then building strategic partnerships as well. Chris?
Yeah. Quite hard act to follow that one. We'll take it back very simply. I'm an investment banker, I'm not a smart VC or private equity investor. So the simple playbook I would say is this. Going back to the pools of capital, US money looked up the P&L, focused 100% on growth. UK money focused on cash conversion, looking at the middle of the P&L. African money, eyes down, profit and yield. So if you can triangulate those three metrics, that puts you on the course to good valuation. So effectively, you don't have to achieve all three, but fast growing revenues, 25-35% plus, with a view to where cash conversion will break even starting on an EBITDA level, and a view to a 2 to 3 year horizon of profit after tax, full sustainability and yield. That is the triangle, that's the holy trinity of valuation. If you achieve that, that's where the top tech valuations come. What does that mean? Look, not every tech business can be an in-country champion. I mean, there's only so many. There's only so many investors. There's only so many PayPals. So I think diversity of product is quite key. But more importantly, we're seeing now is there is still just such a huge number of companies seeking capital that people want geographic diversification within single businesses. Because they want to say, I want to cover West Africa in one big ticket investment rather than trying to find 10 that fit my investment profile. So proving yourself as a business without borders is absolutely key for the technology sector also. But also not going into investors and saying, hey, we've done it in Nigeria, we're going to be in Egypt, Morocco, DLC within the next 5 years. 5 countries, 5 products, 5 years, they'll say. No one wants to see that. They won't even pay for it. And in fact, they'll laugh you out of the room and say, you're not going to have, I want that coffee back. Ultimately you need to go in and walk in with proven capability to cross borders. You can't just People aren't buying dreams anymore. So the playbook is just be honest. I think the playbook is show resilience through things like FX crises. Survival is actually one of the strongest strengths a business can actually show in times like this, in global macroeconomic Ferrari that we're in at the moment. And then focusing on things. They're not building bridges to nowhere in terms of revenue. Revenue is only really good revenue if it's profitable growth. And then focusing on the other two, which is obviously cash conversion and ultimately yield, which is returning money to shareholders. So if you stay within those, that's your playbook, and talk to investors in that measure. I mean, I'm sure Vito and Pierre will be knocking your doors down.
That's exactly the language we want to hear. So part of the, like you, I'm very confident. A lot of the bad behavior, a lot of the valuations, a lot of the things that happened was not a result of the founders. Right? They were taught to be that way. Right? If you want to raise money, this is what I want to see. This is what I need to hear. They've never raised money before. Raising money in venture capital in Africa was new. So they looked to the VCs, to the angels, and what do you want to see?
So we created that problem.
Without a doubt. I mean, it's part of it. I'm not knocking it. It's part of the process. We've got to start from somewhere, right? We were going to have difficulties. We're going to have dodgy founders. When a 30-year-old in Africa, who no member of his line had seen 500,000, he suddenly sees 5 million cash. I mean, we're hoping he doesn't do anything wrong or he doesn't go dodgy, but the chances of him doing that is very high because it's new. You've never seen it before. If you want to look away from that, or look away at your own, but that's just the reality. None of them had built fast companies before. Nobody, very few had access to anything above $100,000. All of a sudden, all this comes in, which was phenomenal. But they're not experienced that. They had never experienced a bad time raising that this way. So a number of these things, unfortunately, and we hope it doesn't continue, had to happen to give us the data, to make us understand what is possible, what is not possible, what we should do, and what we shouldn't do. Right? So now that it's very clear that money is not going after every idea. It's no longer about how big the market is and how fast I can grow. It's now how defensible is the business, is it sustainable? Is it really needed in Africa, or is it a fancy business, right? Now, all these things is what investors are discussing. Watch what innovative founders do. They react to it, right? They react to building with very little capital. They react to building in harsh conditions. They're now very aware. Right? It's the reason why our uncles and aunties were just looking at us when we were saying they should come and invest at these valuations. They're just looking at us, laughing, knowing, because they've been through cycles, knowing that when the federal government devalues, which they will, because they've been doing it every 4 years for the last 40, 30 years, I want to see how you're going to operate. And these sort of things has happened, right? So I'm saying the innovative founders will stand out. The climate has changed, the rules have changed, and they've been given the new rules. And they would climatize to the new rules. In my opinion, I think we are just about to start really seeing African innovation. They've been enlightened on what is possible. They have a bit of knowledge now on software, on tech, and on systems. Now they're going to really look at their environment, the infrastructure issues, the issues that not many people can speak English, not many people have access to mobile phones, and they will come with things that I think would impress everyone. The first wave, they were reacting to a playbook that we gave to them. Right? We gave them a playbook. This is what we want to see. This is what we want to sound. If you tick these boxes, you will raise capital. So they did it. So now we've gone back to them to tell them that no. Everything mom and dad said was real. It has to be sustainable. It has to make money. The thing we've got to be careful about is we don't want to kill innovation. We run out of time. Oh, I thought that was your signal.
It's too hot stuff with the conversation.
So the real thing we've got to worry about is in being sustainable, do we kill innovation?
Yeah.
right? And that's something that we need to bear in mind. So I think founders now, like I said, sustainability is important. Building something that is required and needed in Africa, not just something that is sexy. Is it defensible, right? Yes, we're still looking for the big picture, the big dream, etc., right? But we're looking for sustainability because we know that something phenomenal today, 3 years, 4 years down the line after 1 or 2 devaluations, and the evaluation that 1 or 2 local currency devaluations and a Series A or Series B valuation that is just absolutely ridiculous. The founder now, I mean, we've got one that's about to go through his Series A. And he was going to do it last year, or 18 months ago. And I remember the price he wanted to do. And I mean, I was excited when I preceded this, right? So if you can get away with it, well, that's a problem. That's a few multiples for me. But you know, you're looking at it now. It's just not going to happen. This is 2 years down the line. It's not being able to raise, right? On a tiny cap table, a valuation that is as ridiculous, that was not sustainable, didn't make sense for Africa in that market, right? But he did that because that's what he was told to do. So I think we're going to see, and also I should say this because it would be unfair not to say. I think the standard banks have been around for almost 1,000 years, right? So they know the continent really well. You guys do PE, so you know PE is what we've done in the continent for a while. Investments in early stage technology companies was new on the continent, very new. So it wasn't just the founders that made mistakes, a lot of the investors made mistakes, right? What value were they looking for? Because the investors too followed their counterparts. What does the guy in Silicon Valley say? He says grow at all costs. Well, you better grow at all costs, you know? But he has infrastructure and the companies where he's been built. You know, so maybe there was a time where the investors should have said, I hear what you're saying, Sequoia, but I don't think this would work in Africa. And we did, but other people have money, so they, right? So I just think that now that reality has set in, we were always going to get here. I think founders will build very different. I mean, some people say that the new fundraising is being frugal.
Being frugal.
Yes, right. The new fundraising, just building a company. As if you might not receive capital anymore. And that will stop you from being innovative. Like I keep emphasizing, I know it's very difficult because I've done capital markets and I've done Africa for years. And believe you me, raising $1.5 million, if you're not an oil and gas company, a mining company, or telecoms company, if you're not in any of those 3 brackets, raising $1.5 million for an African company prior to 2015, 20, unbelievable. A brand new company starting by a group of people that don't necessarily have the experience, what they have is energy. It's just unheard of. So, you know, when we go back to all those banks, Zenith Bank, Access Bank, I mean, you know, one day I think people should go and check when they were raising money when may so rest in peace, the great week where they acquired Access Bank off the market. So I can't find out how much it was. Nothing, you know, 50,000, 50,000, you know, but things have changed considerably. So I think we created an environment for them to react, and they did. And there were some winners. Like I said, we did get to $1 billion company. We're meant to be worth $1 billion. I mean, only time we'll find out. There were some winners. We learned a lot. But with what we know now, I think going forward, we will build different. I think founders will really think of the continent, you know, they'll be clear. We're beginning to say maybe they're spending too much time in San Francisco and London. Maybe that's why. Like, you know, they need to be in that traffic in Lagos to understand who they're
I'm going to take that as your prediction, and I'm going to come back to you and Chris. So you have the chance to either predict, make a prediction about the African tech ecosystem, or give an advice to an investor or a founder. So you can choose.
I think, look, I think I'm going to start off, and everyone's always tone downbeat when they talk about sort of the Africa investment environment. So in November, when all of the Nigerian banking recaps were all in the market, So middle of November, we had the Boxer IPO in the market, which was a huge success in South Africa, of about $8 billion in the market in public market equity issuance. Over a third of that was Africa. It's a crazy number. 30%. I've never seen that percentage of global capital being raised in the public markets as Africa. That's a great way to lead 2024, and I think we're coming into 2025 even stronger. You think about the IPO pipeline. We've got MTM FinTech, Airtel, Mobile Commerce. We've got the Money Points of the world. We've got huge, amazing stories, and we're on the cusp of a wave of some real exceptional companies that are going to come to market, and I think they're going to change the way that the whole global investor base looks at Africa. So it's going to be an exciting, I think, next 12 to 18 months, and I think the tech sector is probably going to be the one that benefits the most.
I love that. Thank you. Good.
Yeah, I think in terms of outlook and advice, I think probably I'll echo what I mentioned earlier. I think here, if you're a founder, the ideas are you need to be extremely technical and actually a genius to really kind of get your head above the parapet to get capital. Like, we need this new AI kind of language, or sending rockets to the satellites and whatnot. It is challenging, but Africa, actually, the white space you have for relatively basic things is massive. So it's I think we have such a runway in front of us for just the demographic dynamics are fantastic, and I think everyone talks about it, and I think it's probably been 20 years of hearing that same story, but the reality is I think we were at the start of the curve, so you were having the snowball kind of start rolling down the hill, and eventually you see those networks being built, so people start having phones, there's more roads, there's more bridges, etc., etc. There's more industry, more jobs, and as these things get connected, I think I like the kind of metaphor. It's like you have a brain, you have the different neurons and synapses, but until they're connected, you don't have anything. But once everything gets connected, so that you have a brain and massive potential. And I think I was mentioning that some services that are simply not there, whether it's software or simply basic infrastructure matters. Once they're in place, you'll see an acceleration that will really lead to a breakout of the Africa story. Unfortunately, we're not there yet, and the challenges of simply running a business are still significant, and there's a lot of money that simply goes into just keeping the plates turning, because you're having to have bloated HR teams, bloated finance teams, etc., which really shouldn't. If I see I'm looking at so right now we are in without mentioning too much, I'm in a specific industry where a world-class plant in Europe or America would have maybe 20 to 50 employees, but in the Africa context, the exact same plant will have 300 employees for doing the exact same output. And it's not automation that does it; it's just the way all the basic things in the plant are structured. And it's crazy when you think about it. And you spend days really thinking through the HR. You think, oh, this business is bloated. There's room to take people out. Actually, there isn't. It's just the systems are not there. But people are happy to really put get their hands dirty, put their hands in the engine, create new solutions, create new systems, new software, and fix things, build things. And maybe that's the most important takeaway is Africa is not necessarily about just deploying capital. And I think maybe VC is not as much with that hat, but I think in private equity we see very much that approach, particularly with US or European investors who simply transfer to Africa. It's not a continent where you can just deploy like an LBO, raise some debt, and then hope management just runs the business and you pay down the debt. Private equity needs to be more entrepreneurial, I'm actually kind of taking the operator hat too, and that's a significant difference. But I think across founders, investors, it's getting that building mindset, and getting those networks connected, the services becoming available. Energy also is an important one when it becomes available, water when it becomes available, labor, etc., etc. We'll then have the breakout and actually enjoy that demographic dividend, which unfortunately we're not yet there, but I'm very bullish. I think I'll advise the room to look back at the Asia example. If you think about South Korea, you go back to the 60s. It was one of the poorest countries in the world at that time. It had a GDP per capita the same as Ethiopia, and then they decided to focus on education, get people to run businesses, in a technical way, etc., etc. I won't go through the whole history, but now it's a top 10 economy globally. So, and I think we are on that path in Africa, and very much looking forward to the future.
With a bullish?
Oh, very bullish.
Okay.
Very.
Can we take that question?
Awesome. Yeah, we can take one question.
Good afternoon. My name is Pelumi. I think as an investor, I just want to pick your brain about how you feel. How do you look at investing in Africa from outside? Because I work in the tech media space, and our experience has been.
In that time, I understood what the barriers to entry were, what the challenges were, what some of the things that had worked were. We were able to reshape the policy, and I'm pleased to say that Ghana in 4 years has moved from 0 OEMs to now 15, and it's growing. We're looking at component manufacturing. So Sarah over there is talking about glass manufacturing. I think you've got a role to play in the growing OEM space, if that's of interest. But certainly, policy is key to ensuring that we have big ticket anchor investment. To Cobus's point earlier around SMEs, I just want to say something. I think we need to reframe how we look at SMEs. At the end of the day, it's small, medium enterprises. We cannot look at small enterprises in the same way we look at medium enterprises. I've worked with a pharmaceutical company in Ghana as well, looking for 100 million debt and equity. We're now brought on a transaction advisor to work on that deal. They cannot be classed as the small enterprise, and therefore we need to figure out what financing options are in place, which are lower ticket sizes and can support the growth of that S base, so that we can then see an accelerate economic growth. In terms of how we can boost investment, I think we can only do that through population having jobs. Jobs. I sat in Europe 2 weeks ago with certain banks, and some of the comments were, we cannot operate in Africa, they don't adhere to our ESG frameworks. And I turned around to them and I said, look, the Chinese don't have ESG frameworks, so we need to figure out how we're going to actually engage Africa and understand what it needs, instead of having this archaic view of that we need to checklist all the time of these various frameworks when people don't have food, people don't have water, people don't have access to electricity, and they don't have jobs. So let's get serious about how we're going to kind of reframe this. We are in a new era, I'd say. Yes, we don't want aid. I definitely wholeheartedly agree with that. But if we are not going to look at aid, we need to look at trade, we need to industrialise, and we're going to need oil, gas and coal to do so. And we need to talk about decarbonisation in a meaningful way. So those are just some critical points I think we need to get straight. And I think we need to make sure that those three foundations are available on the continent if we're going to talk about accelerating industrialisation. That's cheap, reliable power. That's access to water, and that's sound infrastructure. Ethiopia has done something amazing with the Ethiopian Renaissance Dam, investing in it, a large percentage of their own financing. Tanzania is doing great things with the building of a bridge, as well as the railway that's going from Dar es Salaam all the way to Mwanza, unlocking a lot of opportunity there for trading potential. So look, there are success stories abound. I've got plenty to share if anyone wants to catch up with me afterwards. But the key message I want to leave us here today is, how can we help Africa industrialise? We've been taken off course, looking at other things. I think we really need to figure out how we're going to create those jobs in the next 50 years. Thank you.
And then continue discussion over lunch. Perfect. Well, I'd like to thank the panelists. I mean, there's such a diverse set of topics that we've covered in one session. I just hope everyone found it insightful and live on that. Let's move to lunch.
UK Africa Trade Corridor, and of course, venture capital investment in Africa. To London, we are very much thankful to our partners at Shogun that they've made this absolutely possible. They've been very, very supportive of our efforts in promoting conversation across Africa. And just bring you up to speed, at Event Hive, we currently organize 21 events across 7 countries, spanning multiple industries from oil and gas to power to real estate, international trade, to banking, to telecoms. There are loads of them that we host every year. So if you're interested in any of our events, the full calendar is at the back of the agenda. You could of course get in touch with our team. We are now going to proceed outside for final networking things again we can have for the discuss. Thank you very much everyone. We look forward to seeing you.
To look at other sectors. So I was recently at the Nigeria